Hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In this installment of the video series, we're going to talk about the importance of financial forecasting as it relates to your retirement income plan. It's a really critical area. If I had to talk about one of the key foundational components to a successful plan and to be successfully retired over the years, it's financial forecasting, because it brings together all the pieces of a retirement plan. So whether you're getting ready for retirement or even retired today, financial forecasting is absolutely critical for most of us. Now, I remember my father, when he retired, it was completely different. A number of years ago, he retired and basically he walked into his benefits department. He worked for SaskTel, and they said, "Bill, here are your options." He picked his options. He had some old age securities, some CPP, and that was the extent of his planning. Boy, have things changed over the last few decades. And so when you look at most people, they're dealing with, I've got RSP accounts, I've got RIF accounts, I've got tax-free savings accounts, I've got defined contribution pension money, I've got a defined benefit plan, I've got open investments that might generate capital gains or interest income or dividend income. I've got old age securities, CPP. Do I take CPP early? Do I defer it? My registered accounts grow tax deferred. My TFSA grows tax free. My open accounts are taxable. I want income that's inflation protected. I want to see where I'm going to land on the tax brackets. You know, are my pensions indexed? If they're not indexed, how much do I have to take from my portfolio to deal with the cost of living increases? It is really, really complex. And so for our clients, they want to know answers to some fundamental questions. I don't want to have more life than income. So how much do I need to get as a return on my portfolio? How much capital do I need? How do I split the income effectively from a tax standpoint? There's all kinds of questions that come up. So we're going to walk you today through a bit of a discussion on some financial modeling software that we use. And it may not sound like an exciting topic, but when you watch the presentation, you're going to see the power, the visual power of these models and how they can help you plan for retirement. Now, the model that we use is very sophisticated. It's not designed for the average individual. It's very expensive to run. So this would be something you would go to your retirement coach, your financial coach, your wealth planner, and you would need to ask them the question, do they do financial modeling? If so, do they have a modeling software that does this kind of financial forecasting? Now, we always talk about our model. Of course, you're at the center of the retirement planning journey. We are big believers in the importance of cultivating a vision and purpose for our retirement, cultivating best practices around health and vitality and energy. Obviously, staying engaged in life through goals and what do you anticipate in the future. Clearly understanding your pension plan. That's very critical before you retire. Is it indexed? Is it not? Is it integrated with government benefits? I mean, all kinds of questions. Investment planning. How will your investments play a role in subsidizing cash flow? Tax planning, always important, of course, estate planning. Now, when it comes to planning, why is financial forecasting important? Because you want to look like this. You want to have peace of mind. You want to understand the context in which you need to plan your finances so you don't have problems down the road in retirement. Okay, so let's take a look at the financial modeling software that we use to kind of give you a glimpse, kind of a behind-the-scenes idea about the power of these financial forecasting models. Okay, so what you see here is FP Solutions Advanced. It's one of a few different solutions out there in the marketplace that advisors use. And the first thing that I'll show you is every forecast has to start with some assumptions. So just for now, the numbers aren't super important. I think just illustrating how these applications work is the important part of this video. So 4% returns we used in this analysis, and we used 2.5% for inflation. Sometimes clients will come in, if you look at 5-year GICs, they're paying roughly about 3, maybe just more than 3% a year. And as a base case scenario, if a client wants to be very conservative, using 3 to 4 is a conservative assumption. And we use 2.5% for inflation. So every year their cost of living will go up by that much. And in addition to that, we go into cash flow numbers. And so if we go to this particular client and we look at what they needed for retirement, go to lifestyle needs, they told us that they needed income of, I think it was around $85,000 per year. So that's an after-tax number, $85,000 per year. Again, the number's not important. What's important is your number, not this number. But in this client situation, we used $85,000 per year in retirement, and we index that by 2.5% every single year. Okay, so let's take a look at the net worth statement now. So when we look at the net worth We'll go to that for a second. Okay, so what you see here is a net worth statement. You can see these clients had some open money in each of their names, $210,000, $286,000 roughly. Embedded in that numbers are TFSA values as well. They had some RSP values totaling $357,000 in each of their names. For a total of $357,000, they had some defined contribution pension value. They had some defined benefit commuted value. They also had some real estate. So we had a starting point in terms of the asset values in their particular situation. Now, the engine of this analysis is this particular page, and you can see here that this green line that cuts across this chart every single year, we took this out to age 90, is a lifestyle need. So by age 90, that lifestyle need has grown to about almost $183,000 per year in after-tax income. The browns here are Sam's after-tax income from pre-tax sources like CPP, OAS, his pensions, and then Sally's got after-tax income in yellow. And you can see that they're running consistent shortfalls between what they say they would like to spend and what their pensions and consistent income streams will generate for them. So what we need to do now is we need to go in and model how much do they need to take out of their portfolio every single year to make up the difference between the income they're getting here and what they say they want. That's where we go into this optimization tool, and so I'll just hit optimization, and what the tool will do is it'll go into different aspects of their plan and draw down on capital to see if they can fully fund their retirement every single year, and if so, what the impact is to their balance sheet, their net worth statement. So it's one thing to see okay, we funded all the cash flows, and the secondary issue is how did that impact our net worth? How quickly do we go through the goose that lays the golden egg every year to fund this cash flow? So you can see the software is working away here. So it continues to work. And you can see that when you look at the analysis, it's every single year it's doing a brand new tax return for each of them depending on how much is coming from RSPs or RIFs and how much is triggering capital gains income. So we'll let this model continue to work away here for a bit. Okay, so what you see here is this sort of turquoise information here on the bars is tax paid money that came out of the portfolio, and it was used to sort of bring the cash flow up to this $85,000 per year. But bottom line on this chart is they had no shortfalls. They had no gaps between what they said they wanted to have as income and what their income actually was. Now, let's take a look at their net worth statement and we'll see how that changed over the years based on their income needs. So the net worth schedule is a good peace of mind exercise for all clients to go through on a regular basis. And you can see the green is their real estate. It was never used to fund income. The different shades of blue would be a combination of pension values and RSP values. This dark blue is their non-registered portfolio. You can see it's fully depleted by their age 83. Their TFSA accounts and other registered accounts are pretty much fully depleted by age 90. So in this situation, if they spent it $85,000 per year, made 4% a year, cope with inflation of 2.5% per year, then it looks like they could fund their income needs to age 90. Now, that works out okay if both of them are gone by age 90. It doesn't work out so okay if one of them is still living. And if you look at mortality tables today and you look at longevity for many retirees, it's a pretty high probability that one of a couple will still be living past age 90. So in this situation, we would want to go back to the analysis and say, listen, what would have to change for us to extend the life expectancy of the portfolio? Do we need to spend a little bit less? Do we need to get better returns? What about tax planning? Speaking of tax planning, one of the most powerful pieces of the software is a forecast around income. And so what this does is shows the client where they land on the various tax brackets. We're showing, for the purposes of this presentation, the three major brackets. There's more than that, but the three major marginal tax rates. And you can see here that Sam is generating income every single year pretty much at the lowest tax bracket. So when he was working, he was bumping into the top tax bracket, but when he retired, he was at the lowest rate. Let's go see what happened with Sally to see whether the same kind of profile is happening for her. So when Sally was taking income every single year, Obviously it comes out, some of it's taxable, and we'll see where she landed on the tax brackets as well. Here's Sally, and you can see that, you know, it's a tighter kind of analysis. We see a few years here where she's kind of bumping in a little bit into the middle tax bracket, but this is a pretty efficient tax forecast for both Sally and Sam. Now the power of this kind of analysis is sometimes when we run the numbers, you can see there's gaps or opportunities. In other words, clients getting RIF payments and other income down the road, they're bumping a bracket, and yet in their early years they might be at a lower tax bracket. So this kind of analysis allows us to forecast and look into the future and then make decisions today about how we can plan effectively from a tax planning standpoint. Okay, so that's the basic tool that I wanted to talk about. Very powerful tool. So we look at financial modeling. We obviously have to, come up with a bunch of assumptions we're going to use. We run the numbers, we do a base case analysis, we fine tune based on the outcomes, and then this analysis defines how we approach the investment planning, tax planning, estate planning. All those areas begin to come together for the client. Great peace of mind exercise to go through. And for our retired clients, we do this on a regular basis so that we make sure they're tracking in the right direction year by year. Okay, let's talk about retirement coaching in a little bit of detail. If you haven't thought about working with a retirement coach, I'd encourage you to sort of ponder it a little bit. As human beings, we have a great ability to rationalize away issues in our planning. And study after study confirms that advised households have better financial outcomes than non-advised households. So, what does a retirement coach do? They get to know you and your dreams, clarify your goals, analyze your current situation, and when they do that, they identify gaps or opportunities that might be available for you to take advantage of. Of course, developing an action plan, and that action plan then, through accountability and encouragement, is acted on a consistent basis over the years. And of course, reviewing and fine-tuning on a regular basis is a really critical part of that process. We put together what's called a gap analysis. So you've seen from the illustrations that we just used how that analysis works. And so we try to clarify whether people are on track for the retirement, and if there are gaps, then we outline strategies and ideas so it can help them track in the right direction. Well, if you'd like to get more information about our retirement planning and coaching services, my email is shumphries@asante.com, phone number 204-977-8049. Of course, you can visit the website at shaunhumphries.com. And when you go to the notes for this particular video, if you go on YouTube, you'll see a link there that will take you to a resource page for retirement coaching. And you can get a free download of a sample snapshot we produce, a retirement tip sheet that you can take a look at, and a retirement readiness worksheet as well. Wishing you all the best in your retirement planning and your wealth planning. You take care.